This is Bullseye Joe, and thank you for watching. It's February 16th, 2009. This video is about where the stock market is going from here. The S&P 500 is currently priced at $820, give or take. And it's going lower. I'm pretty confident in saying that. And so I guess this is a warning video to people who are in the market and believe it's going higher. I think you're very wrong. So let me back that up with some statements. Alright, I've wanted to make a video for a while, but I've been pretty busy. This Barron's right here, this is from 2 weeks ago, and it's titled The Top 1,000 Advisors. Like I said, it's from 2 weeks ago, so it's no longer on the newsstand, I don't think. But in it, they have an interview with this gentleman called Ray Dalio. I don't know. Here it is. I don't know if you can see that. And it says, recession, question mark. No, it's a deep process and it will be long. Now again, I've said in other videos, who should you listen to? You should listen to the people who've been correct so far. He was correct so far. He was warning people in the spring of 2007 about the dangers of excessive financial leverage. So he's one of the, I guess, the good guys. He's not Ben Bernanke. He's not clueless. He knew what was happening or what was going to happen. So basically he says he doesn't want to use the word depression, basically because, I don't know, it's just a scary word to people. Because he calls it a deep process. Basically, he just doesn't want to use the word depression. But he's saying we're in a depression. How do you know we're in a depression? If you haven't caught up to the facts by now, all the banks are bankrupt. The government doesn't know what to do. GM, the car companies are basically bankrupt. Consumers are bankrupt. House prices continue to drop. It's just bad out there. We're in a depression. Unemployment is kicking up fast. Let's see where it is in like 6 months. It's currently, what is it, 7.2%? Or I don't know, but it's been rising fast, and honestly, we're in February 2009. Let's see where it goes. So anyway, so this guy says, you know, everyone should try to understand the depression process by reading about the Great Depression, or the Latin American debt crisis, or the Japanese crisis. So the Japan of the 90s, and I think they're still having a problem. It was Latin America of the 80s, and then it was the US Great Depression in the 30s. So depressions have happened before in the US and other countries, and it really looks like it's happening again. So what I wanted to tell you was just, well, one, this interesting fact. So he tells you that in the bear market of the Great Depression, where the market fell 90%, he said there were 6 rallies of 20% or more upwards during that 90% fall. So again, the Dow fell 90%, basically fell from 400 points to 40 points. Again, this is a long time ago, so the numbers are smaller. You know, now the Dow is like 7,800, you know, which is a lot more than 40 or 400. But while it fell 90%, nothing goes in a straight line. It went up 20% or more 6 times. So if the market rallies, and it rallies nicely, that doesn't mean we've just seen a bottom and it's time to jam back into the stock market. And the other thing he says, I mean, he says a lot. It's like a 3-page article. But they ask what is his current outlook. And he says, in the future, and he says maybe late 2009 or more likely 2010, you'll want to buy into the stock market. He says it is going to be a buying opportunity of the century. Well, I think that's true. I think the market is going to fall a lot more, and we'll want to buy into it once that happens. Because, as this gentleman says, it will be the buying opportunity of a century. So I'm just trying to tell you that not now. I mean, if you want to put all your money in the market now, or if that's what you're doing, or if it's already in the market and you just want to keep it there, those are all decisions you need to make. But taking the money out is an option. That's all I'm saying. It's an option. It's something to consider. Obviously, the people who've taught you that buy and hold is the only way to invest in the stock market they've not been helping you out. Buy and hold has worked for a long time. In fact, I guess it's worked forever. But there's big periods where that's not true. I've talked about it in other videos, so I won't talk about it now. But there's long periods of time where either the market stays flat or drops significantly. I mean, 2008 was an example. I have many friends who say they lost half their money in the stock market. You know, they're in mutual funds, this and that, and they lost half their money. So, you know, once you've lost half your money, that's a lot of money. No matter how much you start with, losing half is a lot. And I'm telling you, 2009, you're going to lose more. So, it's not pretty out there. So I just wanted to also show you this. I don't know if you can see this at all. Not that it's important to see, but this is from the same Barron's. This is an article I ripped out. It's called Look Out Below. And again, it's talking about how the market's going to fall further. And basically this uses fundamental analysis. Talks about, you know, PE ratios. If you don't know what I'm talking about, I'm not going to explain it right now. You can go online and look up PE ratios. So anyway, the normal PE ratio in the market, I don't know, between 12 and 20, I'll say. But it can go much higher and much lower. Now this article says that they expect earnings for the S&P 500, you know, all the companies in the S&P 500, you add up all their earnings, they expect it to be about $64 of earnings per share, I assume, in 2009. And if they put a 10 multiple on that, because that's basically how you get the price. You get earnings times a multiple, gets you the price. So anyway, they're saying if you put a 10 multiple, which is below average, the average is probably believed to be 15. So 10 times the $64 in earnings gets you to 640. So currently the S&P 500 is at 820. So if it goes to 640, as they're predicting, that's a 22% drop. Now, again, they just arbitrarily use a 10 multiple. That multiple changes. As people get excited and believe in the market and want to buy into the market, they push that multiple higher. That multiple can go up to, God, 20, 30, 40. And as people don't like the market, they're scared, they want their money, they're selling the market, that multiple can drop. It's basically just really a measure of how much people are buying and selling into the market will move that multiple. I mean, the earnings of the companies are the earnings of the companies. You know, people buying and selling stock aren't really affecting the earnings of the companies. So, if you threw a multiple of 7 on there, which is a real multiple that the market has hit before, 7 times the $64 in earnings gets you to a price of $448. Again, we're at 820. We're talking about going to $448. Possibly. That'd be very bad, but it's a real possibility. That type of multiple has been in the market before. That would be a 45% drop in the stock market from today. So I told you, my friends told me they've lost, you know, half their money. Well, whatever money they have left, I'm saying there's a chance it could get really bad and they lose another 45% of what they've got in the market. Now, if you split the difference between what these guys are predicting, which is basically a 22%, and what I'm saying is maybe a worst case scenario, if you split the difference between them, you get to a price of 541 on the S&P 500. Again, it's 820 right now. And that would be a 34% drop from here. So I guess what I'm telling you is there's still a real chance that you could lose a quarter to a half of your money in the stock market. And these are coming from people who have been correct. In fact, these guys